Hi again, and welcome to another episode of Onyx and the World of Oil Derivatives. On today's episode, I sit with Fabio Kuhn, who is CEO and co-founder of Vortexa, a leading oil and gas data and analytics firm that focuses on ship tracking powered through artificial intelligence. I'll let the podcast do the talking. I really enjoy the conversation, and I hope you will too. Hi Fabio, how's it going?
Hi, Greg. Yeah, all good, all good. Lots of growth, lots of volatility in the market. It's quite definitely exciting times to be alive. That's for sure.
100%. Now I was just looking stuff up before this call. Obviously, we know each other. We actually met a couple of years ago in New York, of all places. Both have London offices, end up being in New York, but. The Series B investment recently, 70 people, Houston, Singapore, London, it's kicking off, right? I mean, you're doing really, really well.
Yeah, 79 now, things are changing fast. And we're not stopping there. It's this year we're planning to, double the organization, going from 70 to 140, so there's a lot of opportunities for us to continue to expand our product, market, and everything. It's there's so much to be created in this industry. We're very excited, to be in the position to be creating a lot of this, building with our partners and clients. The next generation.
It's very much a tech company, right? As in the structure, the people, is just hiring a lot of developers, data engineers, things like that.
Yeah, absolutely. I mean, our company is quite a big mix between deep tech and domain. So people coming from the market, from trading houses, from super majors, from physical and financial traders, but also on the other side, very deep tech. Big brains doing data science and engineering, and we truly believe that combination is where our magic is. Is in combining the best of both worlds, so that we can create a technology that is valuable, that is useful, right? That can help the market make better decisions, make the market get more efficient, and allow us to continue to evolve as an industry.
Yeah, I think what's interesting is it's not like the technology hasn't been around for a while, but it's just that pretty much since you started, really, where tech has actually started to really take on in the oil industry. I'm not really sure why there was such a resistance. Maybe just more of an archaic market. It's complicated. I know, bigger tech firms have had a look at oil and just seen, it's so granular. So your point about domain, I think, is really important. If you don't actually understand what the data is saying, how are you meant to extract value out of that data? So that's where I thought, we'd start. I mean, I don't actually know that much about your background, and I was looking it up. I mean, you even worked at NASA.
Yeah. No, I was there for a period of time. Quite an interesting time. Where a lot of very interesting science is being created, tested, and experimented. It was in Silicon Valley, so it was Moffett Field. There is a U.S. Air Force, and so that was very interesting time. And after that, I went into finance and in a hedge fund doing statistical arbitrage, quant trading. Doing that for quite a few years, about 5 years or so there in San Francisco. And when I moved to Europe, due to family reasons, that's when I got into energy. That was 13 years ago now, and just fell in love with it. It's so much data complexity. I'd say it's so much interesting to understand what is going on, right, in the physical world, in the financial markets. That link is, for me, has always been fascinating, and since then, I just kept getting deeper into it, and kind of just follow that path, and I don't see going anywhere else, because this is a world still to be created, to be discovered. And first, I was in Germany at E.ON Energy Trading, which now is called Uniper. In its quite early days of their kind of trading organization and being set up, they've acquired quite a few companies around Europe in power and gas, and that was kind of my baptism in the industry before BP hired me, to London, where I was heading their trading front office trading technology and analytics team. So it's a team of data scientists, engineers, analysts, really very close to the trading floor and to the trading strategies and optimization of assets. And that was really when realized that the data landscape was changing so much, right? So a lot of new data sources, especially satellite data, really dramatically changed over the last 10 years. And in the 5 years, especially has been an exponential growth of data, from satellite. But the whole industry have been digitalizing as well, and more data coming, from the industry itself, from service providers in the industry, from brokers, from operators, from agents, from everyone was digitalizing, coming out of paper into a digital form, which obviously led models to be able to start pulling this picture together. But it did happen very fast, like most technology changes, and humans are really good in estimating things that are linear, but when you start getting to exponential growth, non-linear kind of changes, it's hard for the human mind to comprehend the change that is happening, and has been dramatic in the last 5 years. Like if I go back to my times at BP, just 5-6 years ago, and you'd say that one day we'll know what is inside every single tanker, even the small tankers carrying products, like we'll know which product in real time and when it's going to rise somewhere, and how much it is in the ship. Like it would seem like scientific fiction at the time, and I remember this very clearly. And today that's where we are. That's what part of what Vortexa does, and it's mind blowing that it's possible now, and we can understand what's going on like on the fly.
Yeah, I mean, just going back, you came to Europe from Silicon Valley, and the fund was in San Francisco as well.
Yes.
So must have been a bit of a culture shock. I mean, the energy industry, even in trading, was back then like just archaic. Would you not agree? I mean, you must have been a shock on the tech side.
Yeah, I know. And there is this very interesting obviously evolution of markets, right, in different asset classes. And so the market that I was trading in the hedge fund was global equities and equity derivatives, so options connected to equities. And obviously that market is super fast, and it was very fast already at the time. And coming to the energy markets, you see how, at the time, even more than today, the pace of trades, the pace of understanding, the pace of information to trade, the time to market of information was, for me, like shocking. That some of the trades, some of the plays go on for days as opposed to milliseconds or seconds, right? And so for me it was fascinating, a world of opportunities, right? That's what really kind of opened my eyes, to wow, this is an industry yet to be transformed. And yeah, and my whole I'll say career has been always been mixing tech, quant, and trading. And so when you see like a bit like the future of what this industry will be, it becomes irresistible, right? Not to do something about it, not be part of the change, not to kind of be part of that creation.
100%, but I think you just give yourself more credit than that, because I think that whilst it's so obvious now that we're more digitization of financial oil trading in particular, it's not just that the technology wasn't there. People from the outside in always say, how do you still have voice brokers? How is it things still so slow? And it's just this innate stubbornness there. So I was just thinking, even when you moved to BP from Uniper, you must have had to confront that head on, right? I mean, I certainly, even in what we do at Onyx, market making, there's a big resistance to anyone who thinks outside of the traditional oil trading. So, the Javier Blas that just came out with that book, Commodities for Sale. I was reading it, and it just, of course, the mentality then was, you had to be basically fearless. There were physical oil traders, and they made money out of the paper, but it was so linked. These days, they're kind of two different beasts. And, I think there's still, from the kind of legacy oil traders in particular, they're still so stubborn that it has to be, no, it's all about relationships. It's all about, having guts, whatever you want to call it, shoot from the hip style trading, which every year that goes on, it's been proven, it's less and less, it's less and less edge being that way. And then with the evolution of the exchange, I think that's what really kicked it off, right? You have exchange traded, electronic trading even for the swap market, and there's there's no real emphasis on saying, well, I know where the physical barrels are. I know the relationship with the refiners, because guys like you come in, it's like, well, you can now track what's going in and out of these refiners. So, at a trade house or a major, you just don't have that edge. And not to labor this point, but I remember even, just when I started, it was only really that the exchange was taking off then. And before that, most trading was bilateral. And I think why that's so poignant is because a bilateral trade, you don't have to report anything. It's just who you did it with. So, especially like a North Sea window or something like that, where it's very vulnerable to, sudden physical fixtures to China or whatever, if that happens, there'll be a bunch of trading. You wouldn't know about it. You come into the window and you hear a few trades and suddenly it's way higher. That must have been a nightmare to trade, and you absolutely had to have, the relationships and all that then. I guess that's why the market's been so stubborn. But with electronic trading now, it's just, it's exponential. So back to your point, now that the industry is starting to take it more seriously and guys like yourself are being more ingrained, it's only going to go one way, right? I mean, and it's great. It's efficiency, transparency, democracy. Anyone should stand for that. So it's great to see.
There is quite an interesting connection there, because a lot of those changes are have a relationship to each other, right? There's a big interconnectivity on those changes. So, for instance, the increase in data, right, about what's going on, the increase in the speed of that also requires different skills from traders, right? So the traders become, it's not that the relationship doesn't matter. It always matters in this market, right? Even to be able to connect. But what it does is that it also creates the opportunity for those who can deal with data, data-driven decisions, or that use more technology, right, to make those decisions. That's the way to keep up, right, with the amount of data, the amount of kind of the speed in which the data is being served, which becomes hard to be just doing it by hand, So tech is a way, right, for humans to be able to scale the amount of data that can be understood. But what that does is that it also increases the speed in which market trades, the market relates to one another, and that also has an impact on the market itself, right? And so the market structure, right, of people finding better ways of trading, faster ways of connecting, and which starts also contributing to liquidity. And then come, guys like you, which also helps that liquidity magnify, right? And that is then again increase the speed, the need for speed, the need for data, the need for understanding fast. And the thing about liquidity, as part of the work that you guys do, is that it has a strong gravitational force, right? Liquidity attracts liquidity, and there is this potentialization that happens of this.
Yeah, we call it the virtuous cycle.
Absolutely, yeah. And that creates need for better decisions faster, and so this is a loop that is behind the transformation of most markets, and we're living through this now. It's quite
it's very exciting.
Quite an interesting time to believe and be part of this together. Together with you guys here making this history together.
Absolutely. So what you're saying about the actual decision making, I wanted to dig into that because a lot of this is what's changing. So if I started from, again, when you joined BP, I mean, and those days, when exactly was that? Was that like 2010, that kind of time, or?
Yeah, around 20. Yeah.
So we're still in those days where it's bilateral trading. Physical information is very, very, very important. Is in having the proprietary physical information is very important. So I guess if I start with, say, supply and demand models, I mean, I've personally I've kind of rejected the concept of supply and demand model for financial trading because you're trading forward markets. And I wanted to dig into that because so much of the market still relies on supply and demand models. But whilst I don't have a problem, with the concept, of course, if you can figure out supply is greater than demand or the other way, obviously it's great. But what I had a problem with was all the assumptions that were going into these models, GDP predictions. You're not an economist, or are you? I don't know. And even if you are, what economist out there is good at predicting GDP growth and things like that? And also, it's not kind of factoring in, what forward refinery margins are saying, all these kind of things. So I guess without proper data, like what you're doing, where it actually maps definitively, I just see those supply and demand models now obsolete. I mean, you got to agree with that, right? I guess you're going to be talking your book a bit, but obviously that's got to have been the main thing you changed.
It's spot on what you're saying there is that supply and demand matters, but it needs to be to be served. It needs to be understood faster than what was done before. Like what is the typical way in which was done just a few years ago was actually these monthly reports, either from agencies or from market research companies that will produce, and then people will be adjusting along the way based on a lot of guesswork. So what are the odds of that really be reflecting the market dynamic is super limited. So the companies who had a lot of physical information from their trading, from their assets, they were able to better match, what was going on, with the market. And that was more useful to them because they actually could make more supply and demand models because they had better data, like better operational data. And so what has changed is that it starts becoming possible, even without assets, to start forming this more actionable supply and demand that factor into the trade, and starts becoming useful as opposed to not useful.
Yeah, that's exactly it. So if I was to look at it and say, okay, so let's try and predict Q3 supply and demand. Now, you can't really, because you don't know what's going to change shifting wise, but someone says, I assume there's going to be, a 30,000 barrel per day increase in gas oil output in this Turkish refinery. I mean, how can you know these things unless you know their refinery margin schedule, deep information? You're just not going to get it. But I can see with data, you could say, well, the last 3 summers, 5 summers, whatever, or the last time we were in this environment, which you can define as, high refinery margin, high flat price environment, whatever you want to say, you can kind of use the data to formulate much more powerful predictive opinions and views objectively on the supply and demand. And that I'm comfortable with. But I guess before, when I first came in, there was still research companies that try and sell, here's a supply and demand model. Well, here's an opinion on the market based on supply and demand, which is based on me just putting my finger in the air. And that's got to die. That's probably the first thing that's got to die in the next, year. So that would be what I'd say.
Because it is easy for people to make those guesses right in the future.
Yeah,
but if you're a trader, right? You're a trader. You want a P&L. You need to make real decisions and live and die by them, right? It's not just right what you think. You actually live through that decision, and so that's why this actionability of data is so important. It needs to be something you can put to work. Otherwise, it's just not. It's an interesting read, but it's not really useful.
Something you can model. I think generally speaking, I'm getting a bit vague here, but I like to think of like pre-2010 as like the investment banking era. If someone told you something in a suit and a tie and they had this on their CV, you would just listen. Whereas these days, it doesn't. No one's thinking about age, experience so much. It's where's the data? Because if I can hard analyze what you're saying with something tangible, then I appreciate the commentary on top of it, maybe, but without hard evidence, I almost think in every industry it's going that way. You just can't make things up anymore. You can't just be an expert. What does that even mean? So, it's great. That's supply and demand. I think that's pretty clear. That's great. But another big one is storage. So with storage, again, this evolution of technology has been massive, and it just shows. I agree with you. The oil industry is so fascinating in this way. Let me think about this. Let's say, again, 2012, probably around then, to 2014. The EIA US oil stats were huge. When they came out on a Wednesday, the market moved, pretty much all markets moved, not just the headline price. It was a really, really big announcement. And predicting that was what it was all about to a lot of high-frequency traders, macro traders, or even just general traders. But technology always wins, right? So the high-frequency traders and the predictive algorithms, started to kind of move away a lot of edge from the execution point of view. But I think on this point is really interesting as well because, like Genscape, for instance, when they could helicopters see infrared, look at Cushing stocks, and it was fantastic technology. But as soon as that became staple in the industry, the information of what the stocks would be prior to Wednesday's announcement just started to not be a it used to be like, oh my God, I need this information, I've got this information, I can make loads of money. No, it doesn't make any difference now, or it didn't make any difference 2 years later. And it's just the market evolves so quickly to price in these kind of things. You have to keep evolving. And the other thing is APIs and the EIA, US, stock data and the rest of it. It's retrospective. It's last week, so collated the week before that to get last week. So it's always lagged. Whereas a Vortexa can say, well, hang on, I've seen these ships move over, physically seen them move over, so I can tell you, or not moved over, or whatever. So I can tell you that announcement that's going to come in is actually, say it's a huge draw, it's going to be, next week we know already that it's going to be a big build. So you can actually sell instead of buy when everyone else is buy, that kind of thing. So it's just funny how big that was in the industry, how much it shaped the industry, how irrelevant it now is. I mean, we don't even really consider stats a big deal. We just like the volatility. So, I mean, I guess I've kind of said it there, but you've got to agree as well on that.
Yeah, no, it's very interesting because as the data and the tech and the transparency of the market evolves now, and you start being able to look further and further into the future, like with greater and greater level of confidence. So, for instance, you could, in this case, already start seeing the ships that will be going into and out of the US and be able already to anticipate what will be right a couple weeks ahead. Mm-hmm. And a lot of the other patterns are going farther and farther into the future as you start to understand freight better, as you start understanding obviously the forward view on the loading points across the world. You start understanding also everything else. So we see this very interesting frontier of visibility into the future that keeps expanding. And that's fascinating as you're able to.
That's the key point, though, is the forward-looking point. That's very key because we had the polar vortex in the US caused major disruption. The Houston shipping channel goes down every so often. That's significant. You had the heating demand in China that was the record last year. All these kind of things, a lot are based on freight. They can't get the imports in or things stop. All the different key differentials, particularly the swap differentials, they're heavily impacted by this forward looking, and it will stop arbitrages. So, even with the Platts thing recently, even though they did stop it, what I'm talking about here is how they were going to change the data Brent contract to be a CIF methodology, i.e. you could basically ship oil from around the world into the delivery mechanism, and so freight was going to become a huge component. They stopped that now. But even the current methodology for dated Brent you can include CIF BFOET from Rotterdam. So it's a huge component to what you're saying, and I think it will continue to influence that. But the people who are able to use the data, like yourselves, are providing, and be able to figure out forward-looking, I mean, obviously that's going to be the real skill, and that's why there's still room for oil traders with a brain, right? But it does eliminate those who are just relying on the proprietary data of an internal integrated system. Like if you're working at a major or a trade house, they've got fantastic infrastructure and operations all around the world, but every day that goes on, that tech's getting better, it's becoming less and less.
Yeah. I think the times where the seat makes money for itself is going away a bit.
Yes. No, that's exactly what I'm saying. I mean, I see the logic, but it's going to move more to, for instance, the cash and carry play. All the trade houses and majors release their profits. Some of them, in my mind, dubious, but whatever. You think, how can these guys do so well like this without it being so obvious in the market in a way? But the cash and carry trade, for instance, when we were in deep contango in 2020, that was such a big moneymaker last year. Clearly, that's where all these guys, if their numbers are correct, that's where they made their money. And it would have covered losses in directional trading and the rest of it. And it's insane how much money there still is in that when the market presents itself.
This is actually a very good example of an immense amount of profits made last year for those who could understand the dimension of what was going on. So everyone knew that there was some level oversupply in the market, right? So it was going around, but those who could actually quantify how immense that oversupply was and put the bets accordingly, right, in the market and position themselves accordingly, obviously made a fortune last year, right?
And so this is an example. Like we would say, okay, thanks for telling us Mr. Research Agency or whatever, or news outlet, that we're oversupplied. Like, I get that. But what I want to know is, with this deep contango in dated Brent, in Brent structure, in the products, it can be so oversupplied that you can have, all the ships in the world filled up. Freight goes too high, and you can still go lower because there's still more oil. But if you've seen the evidence in the swap market, from the trading, from people's hedges, and you saw the evidence from Vortex's data, for instance, you would have known very ahead of time that the oil market was going to stage a recovery. The levels that we were at were pricing in an egregious oversupply to the point where, for too long, and that's when speculators getting involved, saying, yeah, but Bloomberg journalists and these guys are saying it's oversupplied, oil's going to go negative again. They're not looking at what's actually happening. And I guess you have to have that understanding. But that's, to me, again, going back to that hard evidence thing. Real financial flows and transactions, real data in ships. You could have been on top of this recovery. But there's still that kind of stubbornness I still feel, especially with some of the macro, larger kind of funds and that kind of thing. They just still want to think about supply and demand in its kind of loosest sense. But you can't. You've got to see from last year. You've got to adapt.
Yeah, and as we're coming out of this year, you also see, because the return from this COVID demand destruction has been very unequal around the world. Countries have followed different patterns of of their kind of cycles in this pandemic. It creates very different also patterns of recovery and demand recovery in different products as well. And so what we're seeing this year is so much volatility between products, between ARBs. It's a year where there's so much change. So it's an unequal recovery, basically, what's going on. And that is even more important, right? To be able to have kind of hard facts to really understand, because some of the patterns that existed before, some of the structural arbitrage that people were trading for a long time, they don't sustain during those times, right? So you need to be thinking kind of based on what is actually happening, other than what was used to happen.
I think that is a great point. I'm going to repeat that a bit, because I do think that's a great point, in that these differentials, there's a lot of traders out there who like to trade the extremes, right? They like to sell, a diff, say the difference between two regions, that there'd be a classic kind of global arbitrage. They'll sell that at the extremes because it's too high, and they think if it's too high, then they incentivize imports and it's got to go lower. And if it's too low, the demand region won't get its oil, so it's going to have to correct. And that's generally how people think, and put a huge amount of risks on these extremes. And because it's worked before, they continue to do it. But if you're not, exactly as you say, if the market evolves, which it is all the time, and you don't use hard evidence, you're going to get, it's so true, and it does happen. There's been all these differentials that have just blown out way beyond their historical highs or lows. And so I just think, for trading perspective, that is a really, really, really key point. Is in, you've got an opinion, you've got a view, but you've got the data now. It's out there to some degree. Go and back it up with the evidence, and then make your decision. So that's a really good one.
Yeah. But kind of continue on this point there, because I think you said something that is very is super interesting, because a lot of the trading patterns on spreads are built around this mean conversion in stationary patterns that not necessarily people understand a lot of the assumptions that are going to that pattern. And so when the world is changing, a lot of those assumptions are being validated without people realizing. That's where you see these runaways kind of spreads, and people don't understand why, because they didn't know that there's so many assumptions in what they're looking at. But that's why it is important to understand, what it is that's actually happening. If the assumptions are still right, if that trade is still a trade, and those relationships hold as expected or not.
Yeah. No, absolutely. So another point, your disproportionate regions in terms of, distortion between regions, I should say, needing more or less imports. What do you think about the growth of pipelines? Does that threaten that at all at any point? I mean, we've got the Nord Stream 2, Russia into the EU. That's actually being threatened, they say, because of sanctions. But generally speaking, we certainly find, at Onyx Trading, pipeline markets harder, because you go back to what we said about the older days whereby if you had proprietary information about your system, it was an edge over someone else. But now that there's more democratized data, it's easier. But if you go to pipelines, they still have what they call apportionments, right? So you'll own an apportionment that will be a scheduled time to move oil down the pipeline. So you'll get notified ahead of time when there's a pipeline disruption, most importantly, or when there's, it's coming back online and that kind of thing. And you see traders react to that, who have that information immediately, particularly in the US grades market, for instance. And it's a bit of a nightmare because you say, well, we can't possibly know what's going on in the pipeline unless that information becomes freely available. Maybe more like the power market, you can get really quick live data on that kind of thing. But do you see what I mean? Do you see this continuing with pipelines, or with the fossil fuels kind of dying out in terms of sentiment? Could that mean less pipeline being built and it's still about shipping, or what do you think about that?
Yeah, the whole kind of pipeline dynamic depends so much on the transparency around what's going on in the pipeline. And some markets are more transparent than others, and in some places you can then factor that into the trade more than others. But what it does, even when it's not transparent, is that the market tries to understand the patterns, right, and figure out what and trying to predict what is not transparent in a way. Which also create opportunities in their own right. So this global commodity market is super clever. Is trying to over time to figure out the new patterns, right? The thing is that some of those opportunities takes a bit longer than others to be understood. But nonetheless, I think over time, a lot of the dynamic in terms of, new pipelines, new infrastructure, new refineries, they get, let's say, understood and absorbed into the, the patterns. That in that transition is where big opportunities, exist. And one of the quite large structural changes that has been accelerated by the pandemic now is the whole refinery infrastructure, which has taken much larger capacity on the east of Suez, both in the Middle East as well as in China, right? And so the amount of refinery capacity that came in, online during this period, regardless of the demand, and has pushed out capacity from US and Europe, in less efficient refineries, are created now already, kind of accelerated a trend during this period that is there to stay, right? So refineries that close are not opening again. Some of the refineries that come online in are cost competitive. They're producing more, right? They're gaining market share on the refined markets. In that stays. So now the pattern of refined products has shifted in a great sense. To east of Suez. So it is quite an interesting kind of dynamic that was accelerated by this, but it was already happening to a certain extent before.
Yeah, I agree. It has been that kind of impending doom on European refiners who can't keep up. The only thing I would say is it can go one of two ways in that either the East picks up so much that the East-West differentials kind of price in, so the East versus West product differentials can be high enough to incentivize, net of freight, a positive arbitrage, right, to bring oil over. And if that happens, then you can kind of see refiners who do survive being okay. They think they just need to be hot on the chartering and the rest of it. But the other way to look at it is, but if the refinery infrastructure keeps improving and expanding in the East, then there just won't be any need to for any European imports anymore. So European refiners would die, and then they'll have to rely on imports from the East. So the East-West will flip to kind of West-East positive. Either way, there's going to be some kind of increased freight flow, probably most likely, given where the structures are. But it's quite a hard one to call, actually, that one. Certainly in the pandemic, just to your point, that's what you saw. You saw the first thing, a lot of people trading the market, a lot are based in London, right? A lot are based in Geneva and London. And there's that home bias. You think, there's lockdowns in the UK, so, this market is terrible, there's no demand, But if you looked at the Eastern refinery margins, they were picking up, East-West differentials were picking up, and of course that can drive the whole market. So you only need one kind of cycle of Chinese imports to completely roof the European differentials, and that's what happened. So it's really quite, for me, it's still quite changeable and dynamic.
Yeah, it's super dynamic, and it's also I think it's obviously the market is super volatile at the moment, right, across products, across regions, because of this situation we're living in the world now. But the thing is that even in a normal operating market, the liquidity, the speed of the market information has already increased so much. Like even, let's say, pre-COVID, you'd see like the power of real-time diversions, for example, and the signal that it's already showing on prices, and how people are actually when the shift on the fly, taking a ship somewhere else because there is a better price there, and then trading around that, right? And that is what it is already, the feedback between the physical and the financial coming together, right, on those. And people actually follow the momentum of a physical diversion of ships, and other ships diverting to the same place, right, on the fly. And it's fascinating to see how those markets are connecting as a result of, let's say, the financial and the physical combination. A captain is receiving an order to take the ship somewhere else, right? So it is quite fascinating to see the link.
Turning back, it's not going to make enough money. We're going to turn it back. It's crazy. Being on that ship, it's like, it's insane.
A recent example of that happening quite a big way was on the freeze that happened in Texas recently, right, where so many of the tankers that were heading, New York, and were redirected south because they obviously were very short on gasoline there during the period. But this obviously happened, given a weather change, things, then the market quickly readjusts to be able to supply, to what is needed on a market physically. Which is fascinating to see, the connection of those markets together.
I mean, it's something obviously people outside the oil industry would just balk at. It's crazy, people behind screens, they're looking at the economics purely, and freight's a big part of the economics, and if it doesn't work, then you need to change course. And obviously what that means physically, one of these huge tankers is turning around all their staff. I mean, it's nuts. Just on your point about the financial market, it's quite key as well, because I mean, this is where I'm most interested, because there's the financial futures, Brent and WTI, which I'm personally getting fed up with, because it's so saturated, 5,000 to 1, the actual underlying physical. It doesn't mean anything to us, it's just the headline price that you can price other things off. That's why it's useful, and it's liquid, so you can hedge, and it's good. But there's so much work to get from Brent futures and WTI futures to your delta, to your basis, right, to the actual product itself. There's a lot of trades you need to do sometimes to get it to a more accurate risk. So what I'd like to see is, just like you're saying, the financial markets are much more intertwined into the physical, in the sense that because the swap markets are evolving so much, they actually do align to physical. They're not a speculative contract. They actually are priced to real physical. So they're a much better hedge for your physical. So they're much more aligned, and therefore the market can behave more like it should. And that's great. So there just needs to be much more emphasis on swap markets. I think it's almost a word that puts people off. Or the word swap. It's not actually a swap if you look at what a swap definition is in the FX market, things like that. It's still a future. It's just settled daily, and it's settled to physical. It's still financial. It's still cash settled. So, and it's much more related to supply and demand. So if you want to trade something and you see something on data, trade that. Don't trade, a future that is just a benchmark. So I think we're well overdue more and more financial flows going into, more reflective markets. But again, it's about liquidity, and that's why you said it's a fascinating market to be in. It's great for us as well, because liquidity begetting liquidity. If the swap markets continue to take off, there's so much growth there, and it's really exciting. But
absolutely, because the swaps market can get much more closer to the underlying. It can be more relevant, can be more specific. I mean, just think about, right, everything that is evolving, setting up, let's say, some of the exchange traded futures, right? It is a much it's a much different requirement that's sometimes slower than the market. It's slower than the needs of the market. And so I think that having a healthy, kind of swap a market that is evolving, you guys play a big part on that. I think it's such a great evolution of our our industry, right? Because then what is the result of that? It's that the market can hedge better, right? They can match their risk profile to what is to what is their business. Because the worst thing is be taking risks that you're not supposed to take, or be kind of not be able to protect some of the risk that is there. And so having this granularity, having this a better definition of risk and instruments to deal with that is so key for the evolution of the market, right? And
I do agree with the physical, certainly, but actually I think worse than that is the financial and retail speculators, institutional, huge, dealing with huge funds, which are pension money. This is people's savings, and they're buying futures, Brent futures and WTI futures as inflationary hedges or as whatever it is they choose to do. They're not realizing how much it could be quotation mark wrong. How the delta can be so different. For example, the obvious one is WTI last year.
Yeah.
But it's, you want, even like a shale company, you want to head, there was a shale company that released their profit and loss. And they basically said, our hedge didn't work. It was like, yeah, and you go into their hedge and they were short WTI, but the WTI Midland, which is actually where the shale was priced, versus WTI had absolutely fallen off a cliff. It was minus 20. So you've got all these people saying, oil at 70 is shale oil is going to come back online. And look, I do agree that obviously a high flat price, shale is very adaptable, it will come back online. But that statement is incomplete. And you don't want people making that statement to people who are going to put money into that, trusting a professional, because actually what they should be saying is WTI Midland is high enough to incentivize shale oil. And without that, oil can be 1,000. If the WTI Midland differential was minus 1,000, then you can't. You see what I mean? So there needs to be. It's actually to protect people as well.
Absolutely, is this basis risk that people take, right? Without necessarily understanding how it is, kind of so key, right, to hedging.
No, that's what I'm trying to make a point in, is that yes, it's hedging, but you'd expect the professional traders to understand this. It's actually the retail and institution community I worry about, because there's just so much money there that they're taking all this risk they don't realize they're taking, and that's actually the worrying thing. All these guys want to do is have exposure to the oil price. Now, what is the oil price? Now, for whatever reason, our definitive authoritative oil price is Brent futures. But why is that the definitive price? Even if you were to relate it to physical, you have to carry it all the way to expiry. And if you do take it to expiry, you're pricing to BFOET crude, which is only in the North Sea, so only impacted by North Sea dynamics. Is that reflective of the world? The swap market, you can group things together. You can have dated Brent, buy WTI differentials, and actually be reflective of global crude prices. So when you open the FT in the morning, instead of being like, oh, Brent futures is up $20, 20 cents or whatever, you can say, actually, the global benchmark is this. And I just think we're overdue this, and it needs to be through more adoption of the swap market. But it's the swap word that puts people off, because it sounds like it's bilateral. No, it's a future. You can actually trade on the exchange. Institutions can trade it, retail should be able to get access to it. It's just got to take on. And I think the combination with data, the analytics, the reality, democratization of data in the physical world, what Vortex are doing, combined with actual accurate contracts, it's going to be huge for financialization of oil. But I've got to now mention renewables, right? We all do want to see renewables take off. I think the first step is going to be possibly LNG in ships, maybe, who knows? But what really takes off will need a really strong futures market, swaps market as well. But where do you see Vortexa adapting to that? I mean, is that going to be, are you going to have to start a new way of doing things, or is it going to be just sticking to waterborne ships for now? Or
no, we're already seeing strong signs of renewables, even in cargo level. Like biodiesel has been a major increase in flows over the last year, and it is quite a let's say a new product that is, I mean, I'll say new increase in volume on this product that is very interesting for the market. It's one of the changes that happened, but we see some cargoes of hydrogen being announced.
I was going to mention hydrogen, yeah.
And obviously ammonia is going to be also quite big, because there is obviously some level of efficiency in transporting it. So we will, as Vortex helps and works with the market right in this transition, we will be covering all forms of energy. In our vision. It's not limited to fossil fuels, not limited to non-renewables, right? It is across the board, and will be transitioning with the market and helping that transition as well as it's happening, and help the world make better decisions as well. Because we all live in this planet, and we want to a good transition, but also a smart transition. Sometimes there's so much greenwash that happens in the market, and we also need to be very intelligent about how we do the transition. We still depend on fossil fuels, right? We still depend on that for the world to run. And so how we do that transition, I think, is quite important in a very conscious way, without, kind of without being unrealistic, right? Without understanding the constraints and what is needed, right, from the world. So I think that balance is very important. Information plays a big role in that. Markets play a big role in that. A lot of the transition and changes need to be priced and needs to be incentivized for a trader, right? So you have, for example, emissions, and you have carbon footprints of companies. I think more and more, and you will see for sure, right, in the next few years, already happening to a certain extent now, but will accumulate liquidity, in a big way in the next years. Is the whole kind of precification of carbon, right, across different activities, and that is going to be a big market on its own right. It's already exists. Obviously, it's going to get quite big. But what is the challenge of that is how do we measure, how we estimate, how we make decisions based on that, and that's another area which we see quite a big opportunity as well to help the world kind of understand their carbon footprint, their emissions, and make better decisions according to that. Because when you see some of the big companies setting these goals about net zero, all of those goals are filtering through their organization, and suddenly now people will have goals as part of their trading. It was not going to take long to start factoring those metrics as well. And products will be required to be able to provide that solution for them and for the world. So I think that's how a lot of this starts kind of unlocking and gaining momentum, like in a practical way, in a way that is
actually, in terms of the market should want transparency. It should want evolution. It should want the oil market to continue to evolve, even though we don't want to be relying on oil in the future. Because, as you just said, I mean, if you've got more accuracy and understanding of what you're paying for, you can more accurately make these assumptions and reduce wastage and maximize that transition. I think that's a really good point I haven't thought about before. But what I have thought about before is you should want transparency and democracy, because if you are a believer of renewables and you're a believer of energy transition, you've got to understand the political dynamic. You've got to understand that there's a lot of corruption around in oil, and that's no surprises there. More transparency decreases corruption. It decreases the amount of disproportionate information and wealth in certain people's hands. So you should want this to continue anyway, and that's what technology provides and liquidity provides. But I think that's a really, really good point. It's obviously got quite some way to do that. So I don't know where this comes in, but the valuation of technology in oil, for the perceived valuation of companies in oil that aren't, producers of oil, I think they're doing quite well. If you look at the stock market, right, there's still pretty healthy valuations of people who are public. But for me, there's a lot of growth potential, and the adaptation, particularly in something that Vortexa is doing, is very simple. So I don't know if you're being punished or will be punished, or we will be punished by having such a strong kind of emphasis on oil at the moment. But even though our returns and our growth has nothing to do with the future of oil necessarily, it might be correlated to more financialization or whatever. I think that's something potential investors need to be aware of. But I guess it's quite niche, though, isn't it?
What is very interesting, in what you said there is so by making the market more transparent, more efficient, from an information, from a liquidity, from a market perspective, what is really happening there is actually a bigger impact in many cases than some of the renewables initiatives themselves. Because what happens is that the efficiency of allocation of the natural resources is providing a big benefit, right? The energy is getting to the right place at the right time, as opposed to sitting around and then having to produce more, or the whole world is optimizing to a greater level. That marginal impact is immense in a world scale, right? So when the markets get efficient on information, on liquidity, all of this kind of goes through also a better use of our natural resources physically. It is a big number. It gets bigger, right, as the market is evolving, and that is how a lot of the impact happens. And no place better actually to have an impact than the edges of the market that are most opaque. And today, right, obviously, the oil industry is still relatively opaque to many markets. That's where actually you can cause the biggest impacts, to put light on the most opaque markets and make it more efficient. That is quite a big value for society created on that. Obviously, right, the traders in the market, they are incentivized by profit, incentivized by doing what is best for them. But with the right information, actually, they're the invisible hand that is actually making the world more efficient, right? Based on that information. So it is for the greater good, although, obviously there is the personal incentive there of everyone. It actually drives efficiency in the global system, right, of resources.
Fascinating. I think, yeah, that's got everything out my way that I wanted to say. I mean, Fabio, longest we've properly spoken about all this stuff, and it's really, really interesting. I honestly didn't expect to learn so much, actually, at different points of view as well. I really, really thank you for your time. I know it's a really busy time for you guys, especially, and I mean, all the luck in the world to you guys. And obviously, you're on the right trajectory. You probably don't need it, but yeah, hope to see you again soon. So thanks for coming. Thanks for joining.
Yeah, thank you very much, Greg. And I've very much enjoyed the conversation and learned from you as well in this chat. And congratulations on the amazing work of Onyx. You guys come, very quickly build, such an amazing franchise. And we wish you, all the best as well, and a lot of success. Go
Thanks very much, Fabio. Cheers. Cheers.
Bye.